Hi gang, a new video. This one is called the Master Algorithm Replication. It's been a while since I've done a video, but this one's just in time for Black Friday and Thanksgiving. So let's get started. The Master Algorithm Replication. This is an introduction to the science of what drives financial markets, and the benefit to you as the trader is it will allow you to improve your risk reward ratio substantially. Here's our little disclaimer that we always have to say, and you can read that real quick. So let's get started. Now, the basis for this teaching started with you'll recognize this as the crash, Black Monday, crash of 1987. The important thing for you to note here is the date. While it might have topped over here, the parabolic portion of it happened on Monday, October 19th, 1987. Now that may not seem so important at the moment, but it will on the next slide. Let's go 12 years down the road. And this low over here is generally recognized as the bottom of the correction from the Asian contagion period, where the bubble popped in Japan and they had a decade of killer deflation. That was bad. But the reason that this is here and our interest is the date, October 8th, 1998. Now you might wonder, why is that important? Well, it's important because anniversary dates to the stock market are very important. And I wish I would have put this together a while back, because I realized back in the day, I really wasn't involved with the markets back during the Asian contagion time, but by 2002 bottom, that bottom was October 9th and 10th, well within our plus or minus 2 margin of error. The top of the 2007 market, which was the lead in to the financial crash, that market topped on October 10th. Now, the reason that I tell you that when we hit the September graveyard for stock season, that it doesn't end until October 20th is because of the anniversary date to the 87 crash, and you could see that here. But that's not exactly why I'm showing that to you. I'm showing it because out of this pattern, which was a breakdown of what was developing a possible ending diagonal wedge, the breakout to the beginning of the NASDAQ mania bubble, the biggest stock market mania in history, commenced on October 18th, 1999. Think about that for a minute. The onset of the biggest move in the second half of the 20th century is the exact same day with the margin of error as the crash. Now, you might be wondering, well, why is that significant? What's the big deal? The truth of the matter is that if you understand how markets like to replicate numbers, this one replicated on practically the same day over a 12-year period. And what are the odds of that happening? Think about this very carefully. They came at us in the 70s with a book called A Random Walk Down Wall Street. And I'm here to tell you, and you could see it, if markets were truly random for the biggest drop to start on the day of the biggest bubble, the odds would have to be millions to one against that. So you know that this can't be a coincidence. And that leads into our replication technology. So what does it all mean to this point? Anniversary dates, yeah. Markets are never random. Markets operate on a replication of numbers, and the same numbers operate on lows and highs, and it's not a coincidence. So yeah, this is great, Jeff. This is a stock market history from 30, 40 years ago. How does that apply to my trading right now? Good question, because it does. Just think about the replication flip of numbers, okay? This was a trade that I had just this past week in the Dow futures. This was November 21st. This is the opening half hour right in here. So you get this high, which comes in at 63 bars. That's 63 candles up on a 4-minute time frame. So you got 63 as the high, and you get a sharp knife drop down. And that's scary, isn't it? It's going to make a lot of people back off unless you really know what you're doing. But what ended up happening is that the exact same number at the high manifested at the exact same number at the low. You had to connect a few dots and understand what you're doing, but the bottom line is, well, it's 43,382. We only care about the last three numbers. You got 382 and you got 445, which is a difference of 63. 63 time bars, 63 points, pattern squares out, boom, away it goes. Now let's take a look at recent action on the daily. As it turns out, from my Gann calendar, which I teach there's a separate video here on the Gann calendar. Each day of the year has a certain vibration which corresponds to the Earth's orbit. On this particular low, back on August 5th, that's the 134 DG vibrational day of the year, right? This low, small pullback, so just a 4-day pullback, but the bottom line is it's a 34% retracement. So it's well hidden to the naked eye because, first of all, most people have never heard of the Gann calendar, so they wouldn't know that the most important vibration driving this pattern is 134, and then Fibonacci traders, Gann traders, Elliott wave traders, nobody knows what to do with a 34% retracement. Now, do they? Because everybody's been trained on 38, 50, 61, and 78%. And when you're confronted with a different number, you don't recognize the significance of it and you let it go. But now look at this one. 18,785 pulls back to a 219 DG day of the year. Take 219 to 134. The difference is 85 degrees. And boom, you've got your high-low replication flip, just like I showed you on the archive charts. Same principles. Same principles. Just connecting the dots in a different way because price manifests itself in certain ways and time manifests itself in other ways. And what we're trying to do is put them together. Intermediate traders will engage the market when it's obvious and comfortable, as fear prevents them from getting in correctly before the move is obvious. Price and time replications off the low will solve that problem, and this is a process that takes time to accomplish. But now that you're aware of it, you can't unsee what you've already seen. Now, can you? Let me show you how this works. A lot of intermediate or beginning traders, the move is going to be obvious up here. And you're losing all these points. So what's the fix? What's the resolution to it? Well, you have this consolidation. It's a tight consolidation. It's not fun. It's easy to get chewed up. And the bottom line is, from this low to this pivot's 25 degrees, 25 time bars, and the ratio of the bigger leg to the smaller leg is 1.24. Now this really kicks into gear over here because we have 25 time bars, low 343, to the next low at 368, 25 points, 25 bars, 25 points, boom, great move. So instead of getting in up here where you are opening yourself up to adversity, a shake of the trees, or worse, with what these market makers like to do, their liquidity sweeps, you get in where you can, he who gets in earlier sustains better. They have better staying power. You get in around here, you get all those extra points. And what ends up happening is that you, over time, you start to become comfortable what you used to be afraid of, and you don't like what used to be comfortable to you. Here's another one. What's important on this chart is you got this drop, which is kind of scary. Lots of negative bearish volume down here. But the low is 50 to 61. It's 11 points. In terms of time, it's 02 after the hour to 13 minutes after the hour. And it's 11 points and 11 minutes. And that's where it squares out. Now, what I didn't cover here is that, and not shown on this chart, is that this downtrend was 52 DG down. That's not important yet. It'll be important on the next bar, on the next chart. Because, see, the game on 1 minute action, much of the time, especially in the overnight action, is a run to the goal line, to the house, to the end zone. The big moving, this is a 200-minute moving average. It could stall here, it could pull back here, but how do we know that we have a chance to catch it on a breakthrough? Well, simple, but it's not easy. Remember our master pivot low at 52 degrees down, which was at 2 minutes after the hour? Well, here it's 54 minutes after the hour, so it's 52 DG and it's 52 minutes, and that allows it to break out. And here's yet another one for you. We've got 3 pivots to the breakout. We've got the low to the next higher low, which is 28 minutes. That's 2 minutes after the hour to 30 minutes after the hour. And from 211 to 239 is exactly 28 points. 28 minutes, 28 points, breakout. This is why I believe that if you will embrace this technology, you can slowly over time overcome your fears of taking trades in the more difficult, complex places on the charts where you think you might get chewed out if you don't know what you're chewed up if you don't know what you're doing. But instead, you do know what you're doing. Now, what ends up happening here is this is a crazy consolidation. It's not a fun pattern. This was, I believe, in the evening. Yeah, because it's 1800 hours. It's 1900 hours. It's evening time for me in Arizona in the overnight action. This blue line is a bull trap line, which happened earlier in the day, and you can see they tested for hours. Now, how did we break out of that? Well, the first high is 590. Then I believe it was from here to here is 91 points. That replicates. And then finally, the breakdown hits at 391, which is a cumulative figure, which is the exact opposite of retracement technology because we're adding as opposed to subtracting. This leg down is 274 points. This leg up is 117 points. That equals 391. So 91 replicates with this one and this one. And you could see what happened. It's a great drop. This is the reason for it. And it's also failing at the trap. So here we could say that the bull trap door, which I'll show you in a minute, slammed shut that evening right over here. And there's even another replication because the 540 high now becomes the master pivot, 40 bars down the road, and 40 points from here, 97 to 56, leads to this last part of the move. Here's the beginning of the bull trap, which trapped this leg, and if we extend it all the way back, this group here, high is 691. This one is a 291 cumulative move because this is 176 points down, 115 points up equals 291. 291 matches the vibration at 691, and away we go. Now here's another example of how we overcome our fears of taking trades in the tight places on the chart and passing what was obvious. Now we don't even like what's obvious anymore because it's already too late in the move. Bottom line, the low is 152 points down. This pivot here, which creates a little bear trap, is a 53% retracement. Then, for the kicker, it tops on 53 bars. That's 817 to 814. And look what happened next. You see all of this. What ends up happening here is that, just like in our archive charts that started, we got the high at 867, the low at 667. It's the exact same number. And the last leg from 814 to 747 is 67 points, and from the high, it's 66 minutes from the high. So that leads us to that last low. The next chart will be a combination of time bars replicating with retracement technology. And if you're new, there's a complete teaching on how any number can be a retracement value. What happens is the ratio of one leg to another lines up with the time element to square out, which is going to be new to Fibonacci and Elliott wave traders. Not shown on this chart is the fact that this high comes in at 77 4-minute bars, 77 degrees. But what's important to us is that this retracement replicates. Retracement is price because we're dividing one price into another price. DG is time because we're counting the number of bars. So time and price square out over here, and most people, as I told you, are not even aware of the fact that 76% retracement is a thing. So it's well hidden. Now on this particular chart, it's a little bit different because we're looking to the replication from the prior pivot. Here, we have a move of 170 to 223, which is 53 points, but from the high from 277 to 223 is 54 points, so this is really good. So when we hit 53 degrees or time bars off the high, because it's replicating with the prior pivot, it didn't even matter what the price was. Now, how does this work for swing traders? I just showed you a whole bunch of stuff on 1 and 4-minute charts. This is the SOX, okay? And from the start at the October 22 bottom, which was on a 201 DG day on the Gann calendar, the next low came in on the 277 DG day, which is a difference of 76 degrees. And the significance is that the bigger leg in relation to the smaller leg is 1.76. So we're dealing with replication and the Gann calendar at the same time. Now here, later on in the move, what ends up happening is that we're at the 36 DG day on the Gann calendar because it resets on March 21st. And this is April-May time frame already. From the low to here, it's 135 days on the 36 DG day of the year. Now, want more replication to the prior pivot? Check this out. This pullback at 277 DG was 468 points down. This price is 28.67. Isn't that amazing? Now let's look at the recent pullback on Bitcoin, and the Gann calendar plays a key role again. The first low is at the 40 DG day. The bottom was at a 134 DG day, and then because this came in a few days before the Gann calendar reset for the year, we take 134 plus 6 because it's 354 to 360, and then we recount all over again. That's 140 DGs. So the bottom has the exact same vibration, and that's what turned the market. So this could be very good for swing traders and position traders and people who run money, because this is just about the most precise way to deal with financial markets. Now here's the actual bottom for Bitcoin. This is a couple years ago after that brutal bear market. The only thing that's obvious on this chart is a test of the 200-day moving average. But hey, we get a lot of tests like that, don't we? Which test of the 200-day moving average do we like? Well, as it turns out, from the Gann calendar, from 240 to 349 is 109 DG difference, and from the price here to the price here, the difference in price is 4,108. So you got 4,108 points, 109 DG. That's a perfect square out, and that's what, 19,500? And where's Bitcoin today? It's coming to the 100,000 mark. It was never lower than this thing. And this allows you to take trades in not so comfortable places. So I created a new manual called the Master Algorithm, which is a complete teaching of everything you have here. I've given you a sample of everything, but we go much deeper. And this covers the science of replication. And because it's the time of year, I'm offering my training program at a very steep discount, like 44% off the regular price of $987. This is a discount through Cyber Monday. Includes all the manuals, 12 months of email support, and personal Skype mentoring sessions with me every other or every third week. We cover everything. It's only $547. So you can email me at this lucaswaveman@gmail.com for more information, or to this email inside PayPal. That's where you send the funds to. And what happens in the training program? Well, we're going to teach you this complete replication science. We're going to teach you the complete retracement technology where any number can be valid, how the first leg influences the entire pattern, how the last leg influences the entire pattern, smart money concepts. We cover traps and inducements, and the winning the battle for your mind to help you defeat FOMO, and so much more. Well, that's basically it, gang. I hope you have a fantastic Thanksgiving, and we'll see you on the next video.